And we're live on the Futuristic Friday edition of Behind the Markets. Good morning to you, Ruben. Ruben. I went back in time. My goodness. And I think it's because I heard his voice on the
Go
playover.
all the way to Ruben.
And I even skipped. I went all the way. It's like I really went back in time. You know that we're actually celebrating 5 years of Behind the Markets this year, and I think that's why my brain went back. Good morning to you, Vernon. Good morning. That was a trip back in time. Sorry about that. How you doing, my brother?
I am fantastic. Thank you. Just wondering how you found yourself back in time today.
You know, there's an old song, "Let's Go Back," and the funny thing is, today is Futuristic Friday, and that's the day I go back in time. What a funny occurrence there. Uh, it's an old song by Blackstreet where the beginning is "Let me go back, way back in the time," and I think that's where my mind just came. But the song is actually called "Don't Leave Me." That's a weird, that's a weird trick on that one. But anyway, we got a lot to report today. Today we're going to be going through data from the markets altogether. We're going to be driving through the data from the markets. Then we'll also be touching on Zamstats data. That's going to be our deep dive plus. We'll be doing that as our deep dive. Plus, we'll be going through the activity from the Zamstats data and some of the graphs as well. While we'll also, by the way, Vernon, be going through we'll be going through our topic of the day, which is our topic of the day, which is about deep focus. We're going to be talking about the future of learning and why it's going to be important to become focused. Because everybody thinks being focused is just a statement like I'm focused, man. Everyone thinks that is it, but it's actually deeper than that. It really is. It actually is one of the deepest concepts that you're going to have to actually understand, and it's going to be one of the most important concepts for you. So you really want to stay tuned in that as we talk about the future of learning and what you're going to have to do in order to survive the job market, not just survive, but thrive in the job market of the future, and where you need to position yourself to be able to be the best of the best and to actually be able to build the life that you want. Because remember, in order to have wealth, you need to make money. You have to make money in order to save money, in order to multiply money, in order to maintain money and pass it down from generation to generation. So remember, there are 4 money skills we always pass down here: make money, manage money, multiply money, maintain money. Those are the 4 things you need to be able to do. We have been traveling down the journey of making money, and also we're going to also introduce next week's conversation about the second pillar of the growth mindset. It's going to be really important also today. Right, getting into the markets, getting into the opening part of the markets, we have seen that the Kwacha has continued its electric slide down, all the way as it's losing value, getting to the upper parts of 2130. So we are seeing that the Kwacha is 2142. The Kwacha was only supposed to end this month at 2184, and it's ending this month at 2142, probably 2150. So you can see that it's ended 17 where the US dollar has entered 17 where higher than was expected at the end of the month. That's something to be deeply concerned about. We also are seeing that going into the end of this, going into the next month, we're probably expecting all these currencies to continue moving upwards. And probably at the end of July, we're probably looking at about 26 kwacha per dollar. If this does not turn around and we do not get a debt restructuring very soon, it is the end of quarter one. And though we've been talking about trying to get a debt restructuring by the end of quarter one, that has fallen through the cracks as the main parties have been talking about that. So that's a bit sad. Obviously, on Monday, we'll also be going through what the quarterly statistics for the end of the for all the asset classes are. But the dollar has gained value for 122 consecutive days. 122 consecutive days. And we've actually seen that we've seen the dollar during this last year has gained 18.38%. Now remember, this is what you want to keep as a wealth insurance asset, just in case your broad markets are not performing well. And this year has been a broad market lackluster performance, unfortunately. So the other things that we're also going to be looking at, we also seen here is the rand has moved up to 120. That's of bigger concern to me. That's actually the biggest concern to me. Seeing a rand that's up 12% year to date and up 11.66% just this month already signals to me that anything that's going to be imported from South Africa is going to come in a lot more expensive. And Vernon, like I consistently say, 35% of what we import in this country comes from the Republic of South Africa. And that, unfortunately, is actually going to now translate into imported inflation. Okay, so that's what everyone has to always pay attention to. So 11% upwards on the rand. Plus, we're also seeing South Africa have higher PPIs. So in other words, they've got 12% inflation year on year on the cost of things they're producing coming out of factories. So the cost of things in rands are going up coming out of factories, and the rand has gone up by 11% in the last month. So the two things we need to do to be able to import from South Africa is actually be able to buy rands and then buy South African products. So we're actually importing inflation by shopping with South Africa, and it's also worse. We're importing 18% inflation by shopping in dollars, whether it's from China, Europe, wherever. We are importing inflation as long as we're importing. That's unfortunately what the currency is now putting pressure on, and that's why non-food inflation will probably come in a little bit higher. But it's a little bit surprising, and I'll take you through some of the data that we are expecting. The other part, so the other thing that we saw yesterday was that the bond market did continue, in terms of the main market, did continue to rise back up about 0.07%, up 5.24%. But unfortunately, in US dollars, the bond index is down 11.11%, meaning that it has lost consistent value. And over the last year, we have seen it even get worse. And we have seen that bond interest rates did level off at about 24.81%. It is auction day today, so we are expecting to see the auction results, and we'll give you all those results at the end, on the session of next week, Monday. That'll be our deep dive analysis. We'll be looking at the first quarter of auctions to see how they have performed. They have been weak. This year's auctions have been weak, but we probably do expect that there may be some rollovers that come in, especially from like the 10 years. We have been seeing some of those start to come back into the fold, so that may make this one look a little bit stronger. It's called maturities that we keep seeing playing out. On the stock market, we have been waiting for results to continue pouring in from the stock market. We've seen a little bit of pickup yesterday with Standard Chartered shares bouncing back up 18% after going through a horrendous loss period. So the stock market is back up 6.8% year to date, now beating out the bond market after Copperbelt Energy did have a strong rally of about 25%, pushing up also Standard Chartered has also come back up into the market. So that's actually pushed up the value of shares. And we're waiting, obviously, for dividend announcements, and we're waiting for more AGM announcements. And we're also still taking a deep dive into the ZCCM deal with Kansanchi. We're still waiting. We're still going through that. That is a long document, people. And we're taking our patient time to make sure that we give you the proper analytics on it, and not just a quick run through where you end up losing most of it. But you have seen the stock market is up 6.8% year to date and up yesterday, with the bond market up 5.8%. Now we are seeing that also commodities rose up yesterday, with copper up 9.007 to 9,007. And it's up 0.31%, while oil was up 78.31%. To 78.31, and it's up 0.93%. Gold went back up above 2,000 again, 0.97% upwards. And we're seeing Bitcoin was up 2% again on the day. Ethereum up 0.4%, and gold in Kwacha was up 1.15%. Year to date, we are seeing returns on these assets. Just playing it out here for you. But returns on the assets are that the bond market is up 5.2% year to date. Stock market is up 6.8%. Dollars are up 18.4%. Gold in Kwacha is up 29.7% year to date. And this is the first quarter performance. Bitcoin is up 99.5%, and we have Ethereum up 78.6%. Now, I always must remind people, Vernon, it's like a symphony I need to play out here. You need to be careful. Just rushing in for rates of return is a very dangerous way to try and invest. You must always be risk conscious. And one thing you'll always find about the wealth insurance assets, be it gold, USD, crypto, is that they tend to be very volatile. So that's why you're always advised to restrict it to less than 15% of your portfolio combined, so that you do not take the bare brunt of losses whenever these things happen badly. But I'm sure someone is going to give me an argument and say, oh, but we know what we're doing. Cool. When your fingers get burnt, don't come to me. I have told you. Okay, but I'm giving you the data because that is part of the good diversification strategy. Even people like Ray Dalio put about 2% of their portfolio in cryptocurrency because it's part of his hedging instruments. That's what he does. He keeps 85% of his stock portfolio, his portfolio in the stock market and the bond market, and then 15% of it there. That is called all-weather investing. That is what the advice is. And yes, we do take our advice from some of the greats of the industry. He's the biggest hedge fund manager in the world. He's been doing it since 1971. Perhaps, just perhaps, Vernon, he has got the best insight on it. And therefore, that would be my advice to as many people as possible. So, looking also in terms of how the four horsemen outlook was yesterday, we did see that inflation data came in from Spain. Spanish inflation data showed that inflation is starting to decline in Spain. And we also saw that German inflation data came down to about 7.6%, while dancing around the 9%. So, yes, there's an old saying, Vernon, the way they used to teach people how to say English. Do you remember a show called Mind Your Language? There was a guy. They were teaching a guy named Juan to speak English in that old sitcom, and they told him the rain in Spain falls mainly on the plain, and that's all that came to my mind the moment I was thinking about Spanish inflation data, which actually is showing that the rain is starting to come down a bit slower in Spain, and it is falling mainly on the plain. So think about all of that. We are seeing a reduction in inflation data coming in today. Other big news that we did see yesterday from the markets is that we also saw Chinese composite PMIs up 57, and that's also pushing up a lot of data. So there is good data coming in from the market. That should be good future data for things like copper. I don't know what's going on whenever we look at our copper mining sector, but manufacturing PMIs are up to 51.9. They perform better, but service PMIs. Remember that China is becoming a service oriented economy. The older it's getting, and the smarter it's getting, and the richer it's getting, the more people are opting for services, and the more the service sector grows faster. And this is what you see when an economy develops. The service sector always grows faster than the production sector because because a lot more people decide to go and work in offices as opposed to working in the fields and the factories. So that is what happens when a society gets more educated and more sophisticated, quote unquote. We also saw yesterday that Tokyo inflation was up 3.2%, but not as high as the previous month. So it's starting to decline. And we also saw that Japanese industrial forecasts 2.3% growth month on month last month. And Japanese industrial production was up 4.5% from 5.3% decline. So we are seeing strong sales, and also Japanese retail sales. Remember, Japan is your third biggest economy in the world in terms of individual economies. It's America, China, and then Japan. And Japan is currently is also showing 6.6% growth in retail sales. So the Japanese consumer is starting to recover. The Japanese factories are starting to recover. We are starting to see some strong level of activity. But on the other side of the equation, we did see in terms of interest rates, South Africa had a surprise interest rate hike of 50 basis points as opposed to 25 basis points, which was the consensus expectation because of the worries that inflation is coming up. So this is what I mean when I say we're about to import inflation, and capital access from South Africa has become a little bit more expensive. Also added to the interest rate hike mix yesterday was Egypt, which raised its interest rates by 200 basis points as it's an absolute inflation fighting mode. So they are really struggling and battling to take their inflation numbers down. While South Africa yesterday did read a 10.8% growth in the money supply, ironically, even though they're tightening interest rates. And they also did see private sector credit grow by 8.2%, though it was expected to grow by only 8%, but that's still lower than the previous month of 8.4%. So access to credit in South Africa is starting to slow down as well. So we are seeing a lot of data coming in around showing that financial markets are still tightening. Everyone is still raising interest rates rapidly and in a quick fire mode. We are seeing that inflation is tapering. We did see that consumer confidence is mixed. While Japanese consumers are strong, EU consumers are weak. We are seeing industrial data coming out of China, which is the biggest thing to do with biggest thing to do with the commodity market, actually came in strong. And that also now leads to the markets having a strong open. So in terms of the commodity markets, that leads to commodity markets probably having a strong open today. So our four horsemen are showing us industrials are coming in stronger. China seems to be recovering. That seems to be the constant news here. China seems to be recovering, though the main assets are still waiting. But we are still waiting for PCE inflation data in America. But oil is muted, mixed on Chinese data. OPEC meeting is what they're waiting for ahead of time, while we're still waiting for other data in the market. So that, Vernon, is our roundup of how the markets are doing before we get into our deep dive. And deep dive number one, Vernon, the biggest deep dive of them all today is our expectation of fuel. Fuel today is expected to either move up marginally or at least stay within a range, either up or down marginally or not move at all. We're expecting zero movement effectively because it does not move the bands. Why has this been so? Because we have seen a 0.3%, we have seen a 5.9% shift down in crude prices, but a 5% shift upwards in the dollar. So in other words, the whatever the drop down in crude prices have been this month has been counteracted by the loss of currency in the as well in this previous month. So it is going to offset each other, and probably we're expecting zero movements. Now, there are also the expectations of the fuel supply chain being changed, but we haven't seen what impact that'll have directly on the market. So we are expecting, maybe, because you do have to take into consideration that if diesel starts coming into Zambia cheaper, remember that then diesel will in the future reflect into cheaper costs, because diesel is what we use to drive petrol in. So remember, if we're going to bring finished petrol into the country, we need cheap diesel. So cheap diesel allows the guys who are moving petrol to transport it cheaper as well into the country. So we get cheap diesel that comes in cheaper to lower the cost of production for industries. And then we're also going to have petrol coming in cheaper because the diesel used to bring it in will then be cheaper. So that's the expectation of the future. We're expecting probably diesel prices will come down because of restructuring, but petrol prices should stay flat. That is our expectation, but that is an expectation. There are all sorts of other factors that fall into place. We are not a sports bet, people. This is just the expectation to help guide you based on the research. I've been doing research and in-depth analytics on this. My charts go as far back as 2015 in terms of tracking oil. And sometimes we get it right, sometimes we get it wrong, but generally we get it close. And that is the point of trying to give you some sort of expectations management. So that is the job as the analyst community, not only to go out here and start giving you our opinions, but to also start giving you data, actual data, okay? So that you know what to do. So the expectation, as we said, is that we're going to see oil prices probably have a nil movement. We're going to see oil prices expected to have a nil movement this month. Now, Vernon, one of the other big things that did happen yesterday was Zamstats data. So three pieces of information came out from the Zamstats report. One, GDP data. Two, inflation data. And three, trade data. And all of them came in a little bit mixed. The first one, GDP data for quarter four, did show that the Zambian economy in the quarter grew by 5.6%, but on the year of 2022, we experienced 4.7% GDP growth in our currency. That's actually good, by the way. That was actually good GDP growth for our country, real growth for our country. Most of it was driven by education, transportation, information technology, and manufacturing. Those were the four sectors of the economy that have been driving growth in the last year and also quarter four of the economy. Now, one of the biggest letdowns of the economy has been the mining sector. After taxes that we have helped push that mining sector through, after tax breaks and everything, it appears the mining sector is still withholding output. Mining, in terms of 2022, has gone down from 12%, from 17.5% contributed to the economy, which means it was number one. It was the number one contributor of the economy next to retail and wholesale, down, Vernon, to third place. Mining is now the third biggest contributor to our economy, behind wholesale. And number two is the shocker, is the one that has become number two, was the biggest growth of contributor to the economy, transportation. Transportation services have gone up from 15 from 8% to of the of contributing to the economy to 15% contributing to the economy. So now it's wholesale and retail, transportation, and finally mining. That is the third biggest contributor to GDP. So GDP, yes, mining was one of the biggest drags on GDP. It was actually pulling it back. The biggest drag on GDP, unfortunately, has been our construction sector. It has been pulling back GDP growth horrendously, down 7.3% in that period. So, whenever you're looking at construction stocks, those are going to be the ones that are going to be affected. In fact, when I'm looking at the construction sector, I'm looking at companies like Lafarge, for example, also Chalanga Cement, for example, and I'm looking at their stock, wondering if they've got enough of power around them to push their stock upwards. So that construction sector is quite, you have to be quite careful, especially in terms of construction and construction support businesses. In fact, anything that does construction insurance, construction service provision, it appears we have a very slow and anemic. In fact, we actually have a recession in our construction sector. We have consecutive quarters of economic contraction in our construction sector, which is actually showing signs that Zambia is in a state of construction recession. Okay, and that's not good for us by any stretch of the imagination. That is nowhere good for us as a country because construction, and the reason I say that, Vernon, is that construction is very good for the menial labor work. It's very good for those who work with their hands, those who maybe have got a grade 12 education or below, which is the vast majority. Which is the vast majority of our country. That's my biggest concern whenever I start seeing the construction sector performing as poorly as it has been. To everyone there, sorry, I think we have had a little bit of an interference, but yes. So whenever we start seeing that, that is a hindrance to job creation in our economy, and specifically the low income or the lower education job creation that we so desperately need in our country. Because if we don't have lower income job creation, then we're going to have a lot of people who are on the streets looking for work or either resorting to crime, okay, or cadarism, like we've had to deal with for many years and the years going by. So we want to try and avoid that. Okay, so part of what we also have to pay attention to out of the GDP sector, after the GDP data, is inflation data, and I've got my usual inflation reads for everyone to try and go through. So this is the summary of inflation data that we have here. Inflation, as you can see on the monthly, and in fact, let me just go to the year-on-year inflation because I know that's the headline figures that we all like to pay attention to. As you can see, annual inflation rose up to 9.9%. Now, the last three inflation reads, including the one that went down and the other two that went up, have been what we call base effects. In January, it went down because of base effects, and it's going up again because of base effects. Okay, so everything here is happening mainly because of base effects. So we are seeing that 9.9%, and we have seen a 3-month high in inflation reads, getting very close back to that 10% marker. So 9.9%. And the key driver of it was non-food inflation moving up mainly because of base effects. Now, let's take a look very carefully at what is actually driving some of this inflation and how it came in versus expectations. Total inflation here for the month came in at 1.04%, below the expected 1.17%. Now, remember, the expectations curve, that red graph that you're seeing there, is an average of each month's monthly inflation over the last 10 years as studied by our firm. So what we've actually picked up on is that basically every March you expect there to be about 1.17 inflation. March has become one of your most inflationary months, but we have seen that inflation is actually cooling down from that huge spike that came in due to mini meal prices in December going into January. That has now slowed down from the slowdown in growth of mini meal prices. So what we're seeing here is that we are seeing a final slowdown of the of general inflation. When you look at food inflation, you also see that food inflation finally has also come down below the expectations curve. It's also down at 1.1% when expectations were sitting somewhere about 1.24%. And you can see that food inflation is basically the lowest that it's been out of the 3 months in terms of the monthly inflation rates. So when you say base effects, one of the key symbols that we see is that when the inflation rates for the month are coming down, but the inflation rates for the year are going up, That's called base effects. That means somewhere earlier there was a spike that has elevated the monthly that wasn't being factored into the reads earlier. So that is how you measure base effects, by looking at the opposing movements of the monthly inflation and the annual inflation. So if they're moving in different directions, then the main thing driving that is base effect. So if monthly inflation spikes, like we saw in January, monthly inflation spiked, but annual inflation came down. That was base effects. Okay, so whenever they move in two different directions, it is the base effect of inflation, meaning somewhere in the base, because the annual inflation is just 12 months of inflation stacked onto each other. So I want you to think, Vernon, of a guy of a group of guys standing on each other's shoulders. Okay, and how tall they are. What if one of the people in the middle is extremely tall? It's gonna make the stack look tall of guys. Okay, but if maybe one of them is short, so what you're seeing is maybe it could be one of the ones in the middle that had that spiking effect. That's what we call base effects. Right. So now the other thing that we're looking at also in inflation data is non-food inflation, which also came down below the expectations curve of 0.95%. So we are seeing non-food inflation performing well. Where have we seen inflation in the market in terms of the sectors of the economy? Key inflation contributors were recreation and culture, 2.1%, transportation still up 2.2%. These are monthly inflation figures. And the next biggest one was food inflation, up 1.1%. They're still quite high, by the way, but it's just that they're coming lower than where they were. Transportation inflation is down from 6.7% to 2.2%. The only one that rose during this month was furnishing and equipment, up from 0.7% to 0.9%. But across the board, except for miscellaneous, all inflation reads came down. Also, the other one that rose is communication. That one also rose for the month. Now, what we're calling the kitchen table index, where we measure what's expected to be higher prices on your table and in your shopping cart. Grain inflation, in other words, your mini meal, those prices went up by 2.5%, 2.48%, versus the previous month where they were up by 7.69%. So you can see a slowdown there. Meat is only up 0.48% off the deflation of 1.02%. Chicken and eggs are down to 0.17%. Fish is the one that went up by 4.55%. Vegetables down 0.5%. And condiments down 0.48%. So we are seeing that across your kitchen table, prices are either slowing down or in the negative, except for your fish. Your grain is still significantly high, but it has slowed down significantly from where it was previously. And what are the biggest contributors to the net change of inflation? Most of the inflation change, but where the monthly inflation moved from 1.9 to 1%. That movement was mainly contributed by the slowdown in food inflation and the slowdown in transportation inflation. These two drastically slowed down, so they pulled the inflation rates down heavily. The other one that contributed was housing and utilities costs, that also pulled it down 7.6%, and education costs, that also pulled it down 6.7%. Now, education to me, Vernon, is one of the most interesting things, mainly because education is the star performer of the Zambian economy, one of the biggest contributors to economic growth. If you're looking at an industry where there is growth and where there is activity, it's the education sector. Perhaps the introduction of free education has led to a lot of growth, especially in private education entrepreneurs who get to raise their rates and who get to be more profitable. And it's probably encouraging a lot more people to start schools. Though I always say we need a substantial policy. Agree with me or not, Vernon? We need a policy, and this is just off the record here. We need a policy that may speak to the fact that churches need to really go into schools. Churches need to, as many churches as possible, need to start building schools. That tax exemption status, yes, we are saying that there is a lot of tax support for the sector of the religious sector. But I do think, Vernon, that we should actually have churches building schools and hospitals for them to have their tax exemption status, or at least also make sure that we provide them with cheaper financing for them to be able to do that, so that the church is not only a hallelujah praise God center on Sunday, but we are from Monday to Friday they are healing the people and educating the children. And therefore we can have a lot more private sector education also now funded and managed by the church. You can also have what's called you can also have what are called vouchers, school vouchers, to give parents maybe a tax credit or something, a voucher that they can take to the churches. I think we should also consider the voucher system. Though I know the public school education unions are not a fan of us talking about enhancing private schools. Even take a look at what we did with the loans board. Okay, I mean, sorry, not with the loans board, with the loans, the tertiary loans. We brought up it was brought to an amendment that we should also allow tertiary loans to go to private institutions, and it was shut down in Parliament. And everyone says no, private colleges shouldn't make money. What do you think is driving up the cost, by the way, Vernon, of public tertiary institutions? Because all those loans are being concentrated at one set of institutions. It's driving up the prices, so there's no competition. Okay, so what you're doing is then universities, such as our main universities in this country, can then just raise their prices. If we had that, funny enough, Vernon, some of the teachers who may not like public school, who may say, no, we have to support public schools only. We don't want to be helping these private schools. I always ask people, where do your kids go to school? You know, it's a funny question with us. Where do your kids go to school? Because you always find,
Mhm.
in fact, give me the name of any group of people who are in senior office whose children are in public school or who go
Very
to
few.
or who go to public hospitals. You know how you want it. Can I tell you, if you want to improve the public schools in this country, pass a law that no public officials, especially senior ranking, are allowed to take their kids to any private institutions. If you want to see hospitals
Mhm.
improve, force every MP and everyone in senior office not to go to private hospitals, but for themselves to go to public hospitals and not to go into those fancy wings to be in Gen Pop. When your MP is sick, let them sit in the main ward with everyone. Okay? Then you'll see your hospital start to improve and your school start to improve. But anyway, that's just me. That's just me mouthing off. You know me. So the other, of course, that'll cause chaos with a few people. The other piece of news that we are looking at here, Vernon, for our read here. Sorry, that's a different angle here. Is our trade data. Now, news came in from trade data that we did see that the net exports of Zambia, or the trade surplus, declined by 56% from the previous month, and it's down 56% from where it was last year. As you can see, $142 million trade surplus for February 2023. And remember, I track this stuff in dollars because that's all that matters. So now looking at it in dollars, international trade, we have seen $142 million. It is in surplus, but it's a very low surplus. And in fact, it's one of the lower reads. But we did see, here's where the breakdowns are coming down. We did see that out of the 142 million, $80 million worth of exports in agriculture, up 44% from last year. We are on track, Vernon, to try and beat the 1 billion mark this year. We shall be singing not Little Wayne's a milli, but a Billy when it comes to the agricultural export sector. But non-traditional, non-agricultural exports were really the star of last month, up 111% year on year from last year, $319 million. That's other metals. Copper exports were down 29% from the previous month and down 28% from where they are year on year. The lowest, Vernon, the lowest that we've seen copper exports all the way since September 2020. This is how bad our copper sector is actually doing. This is very weak export numbers that we're getting, and therefore exports in general were $930 million, down 17% from the last month and down 1.5% from the same month last year. We're also looking at imports. We've seen that raw materials imports, the cost of inputs are up 111%, 112%, but we did see intermediary goods down 0.4% on the month. I'm sorry, 14% from the last month. Capital goods were down 27%, and consumer imports are still down 0.8%. The consumer has still not recovered from importing. So, therefore, imports were down 2% from this month, but we saw that exports were down 17%, and therefore we had a trade surplus that was down 56% from the previous month, and that, Vernon, is what is causing chaos. Now, year-on-year growth. In terms of the month, in terms of it is shown by this next chart, you saw that on a year-on-year basis, imports are up 28%, but exports are down 1%, and this is what's causing problems. Since mid 2021, we have had a very tough trade sector. And therefore, we've actually seen that we've had this slimming down. Now, one of the biggest contributors is right here in our face. Copper output was down from 100, was down from 57 metric tons. It's down 21% from the previous month and down 21% from this month last year. Even year on year, you can see that it's down 15% in terms of year to date. We have at 129. So this goal, this ambition to get to 2 million metric tons of copper by 2026, whoo, that's a tough
Hmm,
one to get. If we
that's a
don't
lot.
turn this if we don't turn this ship around, because currently that means doubling what we're producing now. But it appears as we're giving lots of stimulus to the mining sector, tax cuts, tax change, all this stuff, we're still not seeing them ramp up production. I know people say it's our debt, but really, there's also something wrong in the mining sector. As you can see, we've also had a very low output, 57. This is the lowest that we've had since mid 2020. So even the output that came out last month was super low, super low. This is the lowest we've had, as we said, since no, sorry, I take that back, not 2020, 2019. This is the lowest copper output that we've had since September 2019, the lowest copper sales we've had since June 2020. This is how poorly our sector is performing. We are really having bad output from our copper mining companies. And copper exports, as we've seen here, are down to $531 million. However, the star of the show is still agriculture exports. Whatever we're growing is still getting out there, though I think green gold, Chamba, might actually help improve these numbers if we were able to start getting into either hemp or what's it, hemp based export, or also just you know if we finally do get the Chamba story right. That's another story for another day, by the way, Vernon. But finally, that is our deep dive, and those are our charts for the session. We are also seeing that we are generally seeing that markets are showing that the sectors of the economy, be it inflation, is did show higher annual, but there are signs that month on month it's cooling off because it's coming in below expectations, and they all dropped across the board. Monthly inflation dropped, so that's good news. Remember, always keep an eye on monthly inflation, and also that we're seeing that the signs from the trade sector, unfortunately, are showing weakness, with continued weakness, Brendan, continued weakness in the copper mining sector, and yet we're not sure what it's going to take to get the copper mining sector at full speed. That's where the issues are. Getting us to 2 million really is going to be a battle. What say you, Vernon? Because that is a big concern of ours.
Sorry, I didn't get that.
I'm saying, what say you? Given all the stimulus that we've given the mining sector, they're still failing to deliver.
Yeah, and funny enough, though, I feel also there might be a bit of some pressure that we're putting on them, knowing that, of course, it's the mines, and I mean, from inception, from tradition, of course, we know Zambia is a copper producing company. Funny thing is, we still export and then import and buy it, which actually still hits us with regards to foreign exchange because we need to buy it. After exporting, which is funny. I feel maybe if we can have a bit more of maybe regulation, because currently we have miners who are possibly not even regulated because they are not maybe licensed and actually illegal mining, and you find that there is just as much activity that there has to be. But then we have less regulation. You cannot, pinch off taxes because these people out under your greed, so they are producing whatever they are producing and making monies and mining off, the mineral resources, but then we do not have no cut, we do not have any tax payments from them. So it is difficult to really get every nutritional value from the mining sector. But I feel if we can have a bit more of an enabling environment, have a bit more regulation, let the environment at least accommodate more, and see how we can just encourage and stimulate the mining sector. Possibly we could, but personally, I do not like putting all my eggs in one basket. I always try to have a backup plan. So let us not try to lean so much on the mining sector, but see how we can also, be able to, squeeze out whatever we can from these other, factors. Of course, they all have their own challenges currently, owing to the pressure on the kwacha, but I feel we could also just as well, see how we can expedite maybe and see how we can create, facilitate more, cash flow and revenue from other aspects as well, apart from just mining. I think mining may be getting a bit too much pressure, because it's in the mining sector and, they produce copper and whatnot.
You see, my biggest concern is that one, the mining sector is being given a lot of attention, and again, I can tell you, the mining sector has gone down from the number one contributor to the economy down to the third biggest. It's now 12%. So we cannot treat it like the golden child when wholesale and retail are the biggest contributor, and number two is transportation services. Transportation services are now our second biggest contributor to the economy, and they've gone up. In fact, they grew rapidly in the last year. They were one of the star performers in terms of economic growth. Transport sector economic growth was the lead economic growth and the lead contributor to national economic growth. So I keep saying that we really do have to be careful about everything that we're putting on the mining sector. And also, at the attribute, I've said if you're going to give tax breaks to the mining sector, and I've kept on saying this, you've got to make sure that you remember that the tax policy for the SME sector, which employs the large majority of your economy, to make sure that that was handled. I said that that was abysmally handled in the last budget. It should have been they should have moved the turnover tax rate from 800,000 to at least 2.5 million, and finally put in a law that we're now going to inflation track that number. Okay, so at every 2 to 3 years, it's adjusted upwards, and we stop waiting for a decade to pass to adjust it, because that is actually capping a lot of the growth of the SME sector. Because as the price of things has tripled over the last year, that's not helping. So I think that in as much as we want to preach the song that we want to help SMEs, and then just throwing out loans that are never really going to help grow that sector, what are we doing to help make sure that the tax cap that we've put on them keeps growing so that they can grow with that? That is the fastest way to create youth job creation, entrepreneurship. That's actually one of the fastest ways. Okay, I know that we've talked about things like making sure we curb back on NAPSA and them hitting the entrepreneur sector too hard, on trying to make sure that the penalties that they were hitting them with, those things we've been asking regulators to roll back and to become more accommodative. Yes, we have been talking about that, but the tax policy must also speak to SMEs being able to get growth. And one of the main contributors we should be talking about is turnover tax thresholds being pushed up from 800,000 to 2.5 million. We need to reclassify that, because if you're going to talk about it by output, here's what I said. If a person is producing chickens, or if a person is a butcher selling chickens, okay, and we're looking at the number, Vernon, in terms of 800,000, and right now a chicken is 56. Okay, so that's the
Mhm.
number that we're actually putting up here. So if a person is producing 800,000 kwacha per year, or selling 800,000 kwacha per year worth of chickens, that's 66,000 chickens. Now, today, if you divide that number by 56 in terms of the amount, 1 kg of chicken, that's 1,000 kgs of chicken per month. And if you divide that by obviously 22 days of working, or 26 days of working, then also 22 days of working, that's about 54 kgs of chicken a day. Now, if we go back to the olden days, where that number was actually coming from, Vernon, back then a kg of chicken was 18 kwacha. Okay, so when you divide this number by 18 kwacha, this person was producing 3,000 chickens per day, and per month, and if you divide that by 22, that person was producing 168 kgs. Okay, so think about a business, Vernon, a butchery that sells 50 kgs of chicken a day versus a butchery that sells 168 kgs of chicken a day. Those are vastly different businesses. 160 kg chicken a day butchery has got a lot of other things going for it. And on the other side of it, we will come back, Vernon, where we'll talk about our topic of discussion, but I will get back to this point and then close off there. So everyone come up with us on our break for today.
And welcome back. Thank you indeed for having, staying glued to money. Quick one. As we're wrapping up our
Yeah.
thoughts, getting into the five things we need to know. Sorry, Africa Business Report.
Yes. So finally, Vernon, before I go ham on all of this, I'll just leave this be. Finally, I'll go into our deep thought of the day, which has to do with learning. I've talked about the learning mindset and the fact that the learning mindset is the first pillar of growth. And next week, we'll be talking about breaking out of comfort zones. I'll be talking about that in finance, in business, in all sorts of areas, but the learning mindset is extremely important. And I'm going to go through a few quotes here to try and help people see this. Now, the learning mindset, I'm going to give you a quick quote from the same book I've been citing before. This is Deep Work by Cal Newport. And here's what he says about having a learning mindset. And about using deep work and going into deep. He says to learn hard things quickly, you must focus intensely without distraction. To learn, in other words, is an act of deep work. If you are comfortable going deep, which means learning with zero distraction and deeply focusing, switching off everything, putting your phone down and just focusing on a singular task and going deep into this, you will be comfortable mastering increasingly complex systems and skills needed to thrive in the future economy. And I'm going to show you something very quickly that should interest you. However, if you instead remain one of the many whom depth is uncomfortable and distraction is ubiquitous, you shouldn't expect these systems and skills to come easy to you. So remember last week, Vernon, we said that the three people who are going to thrive in the future economy, the greatly restructured labor economy, are people who are either very good with software and systems. You must be a master of a system or technology. You must be a master of a craft, or you must be a master of money. You either have to master a system, master a craft, master money. And if you've mastered one of these three things, you're often going to find yourself thriving in the future economy. If you haven't mastered any of these three things, good luck, God bless, and may the Lord be with you. Now, what's going to happen is that there's a lot of automation happening in the future economy. And I want to show you a quick study from a 2017 McKinsey study, which is actually which might spook quite a number of you as to how much automation is going to change labor in the developing economies. And just quickly, let me grab through this very quickly. This is a 2017 summary of the McKinsey AI report. And here they're showing us, Vernon, that sorry, let me just, yeah, here they're showing us that in terms of automation, you can see here that, let me just zero in quickly. Automated sectors of the economy, you will find that in the global economy, 15% of work is going to be automated by the year 2030. Okay, the year 2030 is only 7 years away, people. So 15%. We are expecting that artificial intelligence will destroy 75 million jobs in the developed economy, but create about 130 million jobs in terms of automation management. And that's going to be for people who have mastered their craft, mastered technology, or mastered money. You'll find that those three groups of people are the ones who are going to thrive in terms of the jobs that are going to be created. 400 million jobs globally are expected to be displaced. 400, Vernon. Not just 400 million jobs are expected to be interfered with during this period. And if you take a look at the types of jobs that are expected to grow, here's the breakdown. Physical labor is expected, obviously, to slow down in growth. Customer interaction is expected to stay the same. Physically predictable physical labor is expected to decline. In the advanced economies and in the developing world, it's going to stay flat. Professional work is going to grow a little bit in the developed world and grow in the advanced economies. Healthcare in both. Builders, people who have got physical labor hands, we will still see those jobs rising in the developing economy, and in the developed world, it'll slow down. Managers will rise, but will slow down in the developing economy. Educators are going to be a very big part of the developing economy. Tech professionals are going to be growing in both sectors. Creatives are also going to be growing in both sectors. You will expect that the skills that are going to be growing are people applying expertise, interacting with stakeholders, managing people, and doing unpredictable work. Data processing, collecting data, those things, Vernon, are going to be slow growing sectors of the global economy, and predictable physical labor is going to be slow growing. In the emerging economies, you're going to expect that secondary education is going to grow in requirement, while in the advanced economy, you're going to need it less. uh, college education will grow in all sectors of the economy. So the labor force will need to be AI tuned. People need to understand the great restructuring is happening here, Vernon. It's not just happening in the global economy, it's happening here. Think about the fact that you don't have bank teller jobs anymore. Banks are no longer opening branches. That's an example. A lot of people can now deliver, so they don't have to have as many storefronts. A lot of people are operating stores and businesses through Facebook, and they don't have to now physically do things anymore. You can run a media company through Facebook. You don't need towers and tower managers. There is a lot of technology that is replacing where physical capabilities could have been. People are hosting classrooms online, and there's no physical classroom. So who's cleaning those classrooms, Vernon? No one. Okay, so those kind of jobs are starting to slowly get washed away into the economy, and it's happening here in Zambia. So in order for you to master technology, master anything, to master things, you need to study and learn these things very well. If you know editing software very well, if you know engineering software very well, coding software, do you know how to manage a piece of technology? Do you know how to fix a solar panel? To learn these things, you need to go into a state of deep thought, and that is what we're talking about in terms of learning. People, in a time where the global economy is getting less and less focused, because we're constantly dealing with social media interruptions, we're constantly trying to check network technologies, SMSs, everything, your phone, Vernon. This thing, this thing is a device of doom because it allows the world to contact you anywhere, anytime. It's good for business in some states, but what it's also doing is it's constantly leaving you fragmented, fractured, and distracted. So you have to learn to put this thing on focus mode. I've got an app on here I call Focus. It switches off. No one can call me. No one can text me. So as long as I've set the timer there, I can't even open it. It's locked. So I have to just work and do what's in front of me. So get used to finding applications to zero down on how much technology you are utilizing so that you can get into deep focus. Once you learn new things, Vernon, you get to do that. And why is deep focus really important? Deep focus is extremely important when you're learning because you harden the pathways in your brain that make it easier to learn something new when you are in a state of ultra focus. And that's going to leave us, Vernon, to our quote of the day by the Catholic philosopher and writer Antonin Dalmace. I am trying to get the last part of his name. Sertilange. That's what I'm gonna say it. Or Sertilange, as since we'll say it our way. And this is the quote of the day for those of you who always need to try and figure out what state you need to be in when learning things, because what you learn and apply grows you. But he says, let your mind become a lens, thanks to converging rays of attention. Let your soul be all intent on whatever it is that is established in your mind as a dominant, wholly absorbing idea. So you want to make sure that whenever you're in a state of ultra focus, this is an excerpt from his writing called The Intellectual Life, a guide to developing and deepening the mind. So those of you who are going to be making money using your brains, Vernon, those of you who are using your brains, you need to make sure that you operate in a distraction-free environment, learn systems, learn your craft, and learn money because those things are going to put you on top. And that, Vernon, is my thought of the day, and that's the future outlook. Thank you very much.
Thank you so much. The good one.
Cheers.